I'm going to ask a series of questions that are sort of designed for conversation among yourself. I don't know that you're going to massively disagree or that you will agree on anything, but I'd love to try and get points and counterpoints. I'm looking at Darcy. I'm going to start with you. So in each, in 2000, as things imploded, there were a large list of corporates that had venture programs, and they all went away. And the same thing happened with sort of large-scale investors in tech who sort of were tourists in tech during the late 90s and 2000, and they disappeared. This is a hot environment for VC. Everybody wants to be a VC, ranging from athletes to musicians to you name it. Is this going to happen again? Are there a bunch of tourists at the party right now who, when things eventually soften, disappear, and is that good or bad for the market? What does it mean?
Well, I think we can all agree that, you know, just as you said, there has been a huge ramp up in the number of corporate venture groups. I think that that's excellent. I think there are some institutional VCs who might have a different opinion about that, but I was having a conversation earlier about diversity of teams, and when I think about the diversity of a board that I sit on that has investors that have, you know, supported a company, you know, what we used to always be able to bring to the table was, look, we're a corporation who's financially aligned with you, but we have a different perspective on the market. We're bringing something different. As to, you know, look, I think, you know, when this expansion cycle ends, as it will, who knows when it will, I think for sure that some people will, you know, disappear. Do I think it will be on the scale of the first wave of disappearance? I think probably not. I think that corporations have realized that they have a lot to learn from entrepreneurs and early stage companies. So, but that's me. I wish I had the crystal ball to tell you. Maybe someone else has a different opinion. Or.
So, I mean, I think a lot of it's actually how the corporate venture funds are structured. You know, back in 2000, a lot of them were from the balance sheet, and as soon as things got tough, the CFO basically said, hey, you know, we're pulling back. We've seen a lot, and this is how we're structured actually too. We've seen, and Google Ventures is like this, Comcast is like this, where they have money that's sort of set aside in a separate fund, and is meant to be there for the long haul, in the same way that Kleiner Perkins and Benchmark are meant to be there for the long haul, right? And so I actually think that should be the model that we all employ moving forward, because it solves a lot of the problems that corporate venture has sort of gotten into over the years, in my opinion. And so, you know, we'll see. I think we would like to think that as a separate fund, we're going to be there even through the downturns, and I do think one is coming. We're telling our companies to raise money. If the money's available, take it, and try and have money for, you know, at least 24 months kind of thing.
Quick aside, who thinks we're at the top?
We're probably pretty close.
Okay.
Yeah.
Okay.
6 to 12.
Yeah. Okay.
So, in answer to your question, of course, we're going to see a downturn and people will flee from the asset class. I'm mindful of the fact that GE is probably on its fourth version of a venture activity. We have spun out 3 venture activities before this, and probably, you know, a lot of it is tied to the corporate leadership and what their objectives are. And it's interesting because we're in the midst of a transition of leadership now as well, but feel great about that transition because the CEO of Ventures just got made into the Chief Innovation Officer, so we feel very good. But it really is about how do you add value and how do you measure that value. A lot of these firms that went away in the past, they went away because they weren't delivering returns. And if they're not delivering financial returns and you're not really delivering on the strategic promise, then it's very difficult in a down cycle, independent of how you're structured. So I think we have to be mindful of doing both.
Yeah, so
Not me.
I'll turn this way. No, so I agree with my fellow panelists. I think it really does depend on how you're set up and what the management's team's expectations are, right? So at Verizon Ventures, we're a highly strategic fund. We have a dual mandate, financial returns, strategic returns. But our management team is under no illusion that if I invest $5 million in a company and I get a 10x return, that really is not going to move the needle much for Verizon. We're a Fortune 14 company or something like that. So when we go out and invest, we put a lot of weight on that strategic side of it. So if that same company, were to fail 3 years later, but save, $1 billion of cost over those 3 years for Verizon, that's a win for Verizon. And so, that's the kind of things, we look for, right? And probably has given us longevity.
So I'm going to...
sorry.
Go ahead.
Yeah, so I agree. I think absolutely is my answer. We, through the access we have through Boston Consulting Group, I get corporate CEOs in all day long, and I tell them, do not set them up. And I make it very clear that unless if you put the right structure in place, and to add to that, the right people in place. So I don't want just some divisional head who's now going to pretend to play venture capital. You need to have real investors who understand how investing works and what it takes to be in the venture industry to give yourself a shot at success. So I agree. The other point, I think the 4-time, at this is a really important one. Hearst has been doing this forever. The ones that you've mentioned, the Comcast, the Intel, they were terrible in the beginning stages. It's that they earned kind of the respect of the Valley, the entrepreneurs, because they kept at it and they did not flee whenever you saw those first blips. So unless of corporates, and most of them don't have the wherewithal to go through these down cycles, are willing to do that long-term investment, hire the right people, set them up like Samsung has set up or Lowe with Google, there's no reason on earth that they should do that.
Alden, I'm going to hit on I want to remind people, if you've got questions, there are cards on your tables. Feel free to jot down questions and hand them to me. Alden, you spoke about having strategic returns be sort of a part of your mandate. There's a long sort of knock on corporate ventures being dumb money because you value things in corporate worlds that are strategic but don't necessarily have financial returns from the outside that aren't easily seen, easily valued. Again, I'll make it a free-for-all. I'll start with you, Alden, since I'm asking. How do you incorporate strategic returns into what you pay, and how do you make sure that that doesn't force you or drive you to overpay for things?
So the strategic component of it really doesn't drive how much we pay for something, right? Like, we have to be diligent stewards of Verizon capital, right? So we're not going to look to overpay for anything, right? The strategic component is whether it comes into play more about whether this would be a good investment for Verizon, not the actual valuation. So I'm a recovering banker, right? So by definition, I'm always looking for value, right? I tease my colleagues on the West Coast all the time. It's like, hey, you guys don't care about revenue, you just care about how many people are playing with your EPI or whatever it is. So, that's the discipline that we take at Verizon. We're not just saying, hey, we're Fortune 14, so we can write any size check regardless of the valuation.
But the thing is, you said it before, a lot of corporates, and you're not going to move the needle on the return. So it's a tough balancing act that you have to do between providing strategic value as well as market value. So that's kind of one of the flaws inherent, that most of these funds are not going to return a big enough return to move the needle in a Fortune 50. I mean, look at the check size that SoftBank is having to write now. $100 million checks. That's a sure sign of a bubble if you've ever seen one. So if you're looking at this, how does a corporate venture actually?
So it is what is the strategic value?
That's
I think you can think about some groups set up, they're under the CTO's office because they're looking for technology. Other groups may be set up because they think they're going to make a financial return. That's crazy. Or they can, at least to be self-sustaining. There's strategic value in looking at where markets are going, and then there's really cultural change as well in helping people think more innovatively. So when I think about how we're delivering on that strategic value at GE Ventures, we spend a lot of time making sure that our companies get connected into GE. That said, we're not afraid to invest ahead of the businesses. Sometimes the business units have representation on our investment committee, but they don't have a veto. And oftentimes they'll say, well, that's interesting. I don't know where that's going. I'm not sure that's strategic to me today. And then 3 months later, 6 months later, a year later, they'll go, you know what? We'd like to spend more time with that company. So the businesses get caught up in their quarter to quarter, and we have to be able to lift our heads up and think ahead of them, but understand what they're living through and prepare them for the future.
Right. I mean, I think sometimes I joke that, and this is not a knock on the business units, but sometimes the business units' feedback, not necessarily the tech diligence, but on sort of the market timing, is a counter indicator of whether or not you should invest. Right? Because they're so focused on the next 12 months.
Their
right?
thing, and you're investing in what's going to rock their world.
Right.
Yeah.
And so we rely on them very much for the tech diligence, but not necessarily on helping us market time, because we get those calls a year later all the time. Right? The other thing I would say is we take a portfolio approach, really. So there's some deals we look at that are super strategic, and we're not sure what the financial returns are going to be, and others where the strategic fit's not so clear, but we're really excited about the financial opportunity. And the last point I would say is that it's important not to get into the trap of being too prescriptive for trying to anticipate what the strategic value is going to be, because a lot of times things sort of come at you sideways after you've invested, because the company will pivot, and then it'll be interesting strategically. So you can't be too prescriptive. So.
What is the thing that I'll go through each of you again. I'm trying to avoid doing this, but I'm going to end up doing it a bunch of times. What is, if you were to look at something you've done as an investment over the last 5, 7 years or whatever it might be, what is the investment you've made that sort of best typifies the kind of things you do, the things that show you and your platform the very best in 45 seconds? Whoever wants to go first.
Yeah, I could go first. The strategic returns that I mentioned before for Verizon Ventures is providing intelligence back to the business that will help inform their strategy, the financial returns component, the ability to drive commercial agreements to either cut costs in the business or help drive revenue synergies, take some new product to market or something like that. And we do that in a variety of different ways. Yes, we could hit the pavement, find companies, bring them back to the company and say, hey, let me introduce you to this company, they do this. We host events called the Venture Forum where we talk about a particular topic. 2 years ago, we were talking about IoT. We brought a whole bunch of IoT investors and startups in and some of our corporate peers, and we had a great discussion about it. One of the panels that we had 2 drone companies on it and a data analytics company that was focused on farming. We ended up making an investment in 2 of those companies, Precision Hawk and Skyward. They went out a few months later, did a pilot. The pilot was wildly successful, and then we ended up acquiring one of them, which was Skyward. So that, for us, was a great success story that highlighted our platform. On the financial side of it, if you look at the exit that we had with Skyward, yeah, it was nothing astronomical, but the value it created for the business, that was a home run.
So we just had we're 3 years old. We just had our first exit in September, which was pretty fast. Thank you. We teamed with the large insurance company Allianz, who spent a decade trying to penetrate the Chinese market and got about 400 customers after spending hundreds of millions of dollars. So we built a startup company. Of all things, we created a baby heart monitoring device to reach Chinese mothers. And the point being is once you develop the trust with these mothers, and then when you have this product that is touching them 4 times a day, that would be the right time to sell them insurance rather than building an insurance app. And as a result, upon the sale, we had over 200,000 customers. We had about a 30% ownership in the company, and we launched in China, and it's now been sold to a division of Motorola. So successful outcome, kind of what we do in 45 seconds.
So I'll talk about my portfolio company, Via, which is a ride-sharing business here in New York. It has not exited yet, but they have raised over $300 million. This is a company that is relevant and provides strategic insight to Hearst in its automotive B2B group. Next Generation Mobility is one of our investment theses. We have a handful of investments there. And, you know, VIA also has the added benefit of fulfilling our financial first mission. So when we were set up in 1995, the driving factor was actually financial return. I think we're kind of reverse engineering. I mean, forever the strategic insights have been useful, and we get gold stars for all of that, and there needs to be some nexus with Hearst. But I think increasingly we're creating our investment themes in ways that matter to the corporation.
I'll talk about three, because we're a huge conglomerate. We do a lot of stuff, so I feel need to do that. We bought a company called ServiceMax last year, which was a company that the Ventures Group had invested in. GE spends a lot of time and makes a lot of money servicing our infrastructure assets, and so we invested in the company. We were using their tool, and now it is the critical part of our Predix industrial internet solution that we're now taking to the market. So kudos to my software team that led that. We have a similar drone thing. I lead the advanced manufacturing program, and the very first investment that we made was in Earware, which was a drone company. We have an aviation business. I talked to my aviation business about that. They said, drones, commercial drones. Yeah, it was on my 10-year roadmap. It fell off. Okay, and this was maybe 2 years ago or 3 years ago. They say if you want to invest in it, go ahead. But you know, we make software for flying Predator drones, but not for commercial drones. So we made that investment, and now we have in our new business creation group 2 drone-related companies that we've started. One is focused on leveraging these really low-cost commercial drones to do inspection of industrial assets. And then the other one is the same software group that kept going, yeah, maybe we should take our software for these Predator drones or military drones and bring them down. So now they're working on, with the FAA, around how do you regulate that drone airspace. So what had fallen off their 12-year, 10-year roadmap now is squarely center what they're working on today. And then finally, I'd say in my energy group, we sell to utilities. We don't really sell to consumers, but we have invested in a number of companies in the solar space and in the battery space that have a business model that's selling directly to consumers, and that's been incredibly enlightening for our energy business.
So I'll do a quick one. Up in Boston about 3 years ago, we found a company called LoopPay, which had this really novel way of using a magnetic loop to transmit like credit card information to any mag reader. And our business units actually weren't all that interested in it, the mobile team. We invested, and then again, like 6-12 months later, whatever it was, they came back and they ended up buying it, and that became Samsung Pay. And so, you know, that's a big one.
Yeah.
Can I ask you guys a question? Because you buy companies out of your portfolio. How do you manage the tension between, you know, the corporation wants to pay the lowest possible price and the ventures groups want to sell at the highest possible price?
So it's interesting. For the most part, we're not the business development people. So there's a separate business development group that is off responsible for making the bids or what have you. So I try to remove myself from the negotiation.
Yeah, we're in the process of actually buying a company that's in my portfolio, and I haven't talked to the company in 6 weeks because I'm just staying out of it.
Quiet period.
Yeah, totally.
So I'm going to shift gears quickly for a last question, and that question is about sort of why we're all here. We're here, it's culture shift, and the question I've got is, how, whether it's tactically, through programs, how do you attack the issue of diversity, and how can these platforms be leaders where other platforms can't?
I'll
Okay,
I'll start. So GE Ventures is, I'm super privileged to be there. All of first of all, the venture group is headed by a woman, Sue Siegel. And then the energy, healthcare, and my own investing practice are all headed by women. And the lone guy who heads a practice on the investing side, he actually reports to a different guy. So it's kind of interesting. So we're very big on that. We did a census of our portfolio company leadership, and we follow a lot of financial investors. When we did that census, we realized that we didn't have a lot of female CEOs in our portfolio. There wasn't a lot of diversity there. But then when we looked at the companies that we started in our incubation team, they were like all headed by women and minorities. So it's just kind of interesting. The deal flow was a reflection to some extent of what we were getting from our colleagues in the Bay Area. Myself, I'm very mindful about the team that I've brought together, at least for me, and I know there's a lot of talk about unconscious bias. I'm just consciously biased to getting diversity in my team. I probably have, of all of the teams, I've got the most diverse in terms of both gender and ethnicity. And I think those, I just think when you're looking in different communities, that helps you. And then we're sponsors of activities like this and others to help bring a more diverse pool of candidates to bear.
Yeah, so Verizon Ventures is a pretty diverse group as well. I think we have equal representation of men and women on the team. Culturally speaking, it's also quite diverse. We also have a sister fund, if you will, within Verizon called BBG Ventures, stands for Built by Girls. So they do investments in seeds and tiny Series A startups. And occasionally they'll kick stuff up to us when they have entered a Series A that's too big for them, and we help them out on occasion. Aside from that, we work very closely with the Verizon Foundation. So I'm up here today speaking because the Verizon Foundation extended an invitation for me to come up here. So they're very well in tune to things like this, things like having entrepreneurial type contests for high school students in low-income areas. They constantly have us judging them or helping them come up with ideas and polishing their pitch or working with them on their technology. So we have a variety of different ways of getting engaged.
So I love the consciously biased. I'm going to steal that. So we do an average job at best. We have some people of color. We also have geographic diversity. So we have fund in different parts of the world, which gives us diversity as a result of being in the different locations. But our track record with women is terrible, and there's no sugarcoating that one. And I think it's pretty across the board. So it's something we are actively trying to fix. Period.
Follow up on your answer I think you see the way that gets reflected at times is that deal flow ends up looking like the people who work for you. Do you see a bias towards companies not run by women?
Well, we're not terrible below the GP level.
Okay.
So it's just at the senior-most decision-making. So we do see a lot of diverse, whether it's people of color, LGBTQ, women. We see a lot of different deal flow as a result of the force and the activity. And the senior-level decision-making and the investment committee, that's the million-dollar question, right? Okay. And yeah, it's a little bit skewed.
Okay.
I think now is my time for the advertisement. We're hiring a senior associate, and I'm running the hire. And I am the person on our team who is actively pursuing underrepresented investors, entrepreneurs, employees. So
You gotta get Andrea's list.
I know, right? I do. So it's on Workable. Check it out. We put it up 4 days ago. So yeah, we need to do better as well. I'd say average at best. We do better with women and less with ethnic.
Right. So I would say we do okay as a group. The geographic diversity, I think, certainly helps. And I think importantly, and this is just a recent development within the last probably 24 months or so, we actively track sort of in our deal flow system, companies that are founded by people of color, women, et cetera, et cetera. So we know kind of what the deal flow looks like, and that's where we need the most help, frankly.
Do the
It's
rest of you
sourcing.
track it? Does anyone else track that sort of data?
Yeah, we're trying to do a census on that. And I think one of the things that we're also working to do, just trying to address the problem in our portfolio, is how can we bring more diversity to the boards? And so that's something that we've been working with Andrea on. So to the extent that we're investing and we have the opportunity to get diverse people on the boards, we're looking to do that.
Great. Okay, I'm going to switch to questions from the crowd unless anyone has something I should have asked I didn't ask. Okay.
Rick's about to be asked.
Yeah, exactly. So among you is significant capital. Who is investing in inclusive AI? AI is the next huge exclusionary force. How are you attacking AI?
It's a fantastic question.
Where are you?
I think it's a
Yeah.
critical question, and we actually have not had that discussion at a partner meeting. I think we absolutely should. I think it's an excellent. Whoever brought it up, thank you for mentioning it.
Yeah, we have an investment in AI focused around this exact area. Can't get into too much details because we're still in stealth, but it's been about 8 months of investment so far, and it's a very important topic for us. Finding the AI engineers, not that easy though.
And just to be clear, we are investing in AI, just not the inclusive AI. Yeah, and I think it is a critical thing.
Yeah, so AI is a big area of interest for Verizon Ventures. I mentioned it's something called the Venture Forum, an event we throw. Well, we held one on AI in May, just past May. And we asked investors and, how do you go about evaluating AI startups, right? Like what makes a good AI startup? And no one really had a great answer for it, right? Because you could have the best algorithm, but you have no data. And, and then it's like this kind of like chicken and the egg cycle thing going on. It's like, okay, well, so who's going to solve the AI problem? Is it going to be the big corporates? Is it going to be startups? Is it a partnership, a dance, if you will, between the two? Like, how do you do it? And so that's something that we're not necessarily deploying a lot of dollars behind right now from an investment standpoint. I mean, we do have an investment in a company called Spark Cognition, which I'll give a shout out to our fellow co-investor, Boeing. But we're not, in some ways we feel like it's kind of one of those fads, right? Everyone's talking about AI, so we have to be at the AI party, otherwise we're not cool, right? And so, again, like I said, I'm a recovering banker, right? I like to take a very practical, value-orientated view of it before actually deploying dollars. So I think it's important. I just don't know how to play it yet, and I think a lot of people just don't know how to play it yet. They're just doing it because they're following the trend.
We're investing in it, and we're trying to use it in our operations. But I have seen the bias. So, for example, we were doing using AR in some of our complex assembly, and women and Asian engineers were having a hell of a time speaking to it and getting it to understand the commands. Yeah. So we realized we had some biases with those training sets that really were delivered to us, but we could play a role in helping to improve.
So last question, and I'm gonna expand on the question a little bit. The question is, how do you use outside third-party incubators, accelerators as part of your strategy? I'll speak for the room because there are micro funds and accelerator strategies and folks with those sort of entities in the room. How do they best interface with you? How do you think about them as sources for deals, and how should they think about building relationships with you? I started with you, I'll end with you.
So obviously, we're on top of the big name incubators and going to their demo days. We welcome inbounds from micro VCs. We think it's a great follow-on opportunity for us. And to the extent that the vertical focus of the micro VC lines up with what our investment thesis is, we're very excited about that and, want to make those. We don't invest in funds, so we need for those relationships to be, pass off of deals or, more like co-investor relationships.
Yeah, and I would say, please err on the side of getting in touch and sending deals because one of the ways that we are set up is that even if we don't think a deal makes sense as an investment, if we can be helpful to the company in getting them to the right business unit inside of Samsung, et cetera, we have 40 people in Seoul whose only job is to actually help us do that because Samsung's so ridiculously big. And so even if it's not an investment opportunity, like we want to be helpful. Part of our job is to actually put a sort of really friendly face to the entrepreneurial community for Samsung. So we generally do try and be helpful.
So we invest in accelerators or work with accelerators in a variety of different ways. So we've worked with Techstars on a number of accelerators, one for mobility, one for Internet of Things. And the idea behind that is to just see a lot of volume of companies, right? We want to be in the space that bring us the volume. There's two other ways in which we also do it too. We invested in an accelerator called The Hive, which is a big data and AI accelerator, which we did years ago. So we knew that AI was going to be important. We wanted to get an early look at it. So we're not necessarily looking for volume of companies there. We're looking to learn there. And the third and final way is we just created our own accelerator program. It's called the Media Tech Program. We solicited our RGA to help us administer the program. And we are working with our product teams and our business units to hand select the companies that we bring into it. And so that's like for a much more richer and deeper engagement with these startups. So that's how we use accelerators.
I'd say we're the same. We sponsor a bunch, particularly in vertical areas. We're in the IoT one here, Techstars IoT here in New York with you guys. Part of this cultural change that I talked about at the beginning is I think the business unit CEOs are starting to say, hey, put me in touch with a lot of startups. They want to hear from a lot of them. And there's a little bit of Silicon Valley voyeurism, tourism going on. And that's fine. But we host a lot of demo days for our CEOs. And so we're always happy to help you get connected with the right people as well. So,
Great.
Reach out.
I want to thank all 5 of you for your candor and for sharing experience with us. Can everyone help me give them a round of applause?